Hi, today I'm taking a look at Lemonade, the revolutionary insurance company that is shaking up the old school insurance industry. If you're not familiar with Lemonade, here is Daniel Schreiber, the founder and CEO, explaining how Lemonade is a little different to other insurance companies.
Our strategy is really quite simple. It begins with being customer-centric, devoutly customer-centric. That may sound trite, but in insurance, it's a formidable task. The very business model of insurance is seen as pitting insurers against their customers. But if you do the hard work of modernizing the business model and actually get to delighting customers, that can fuel rapid growth, very rapid growth. Growth is valuable in and of itself, but for us it does double duty. It generates huge amounts of highly predictive proprietary data. At its core, insurance is about monetizing probability theory, and so a sustained data advantage means a sustained advantage at pricing and underwriting risk. That's the very heart of insurance. Finally, given how our business is built atop of a digital substrate, those data serve as training data sets for many aspects of our business, allowing us to refine our algorithms, increase our efficiency, and lower our costs to the delight of our customers. And so the loop closes, the flywheel turns, and the moat grows stronger with every rotation.
Okay, now in my video today, I don't want to come across as cynical of Lemonade, but with so much hype around the company, I want to talk about the pros and cons subjectively. As you have heard me say before, investing is more about controlling your emotions rather than being smarter than everyone else. Check out all the titles of these clickbait articles about Lemonade. So as you can see, the public relations team has been where a lot of money has been spent, and it has definitely worked. And for a company that only started 5 or so years ago and is bleeding money, which is the blue bars on this graph, well, how is it worth over $5 billion? So let's go take a closer look and see what this is all actually about. For those of you who are new to my channel, well, welcome aboard. What I do when I analyze a company is I take a look at the industry they are in, the competitive forces they face, the management team running the business, my valuation, and then my opinion. Now, I get a lot of people asking me to make a course teaching investing, but look, I don't really want to make a course. I actually don't think you need a course either. I didn't take a course, and it's better to get multiple opinions anyway. So, in the description, I have a list of books that I highly recommend. And I have read all of these books at least twice now and still get a lot of value out of them. So instead of going through some course, read all these books and that will be far, far more valuable. And if you buy these books from these links, you don't pay any extra, and I think I get like 50 cents or something from Amazon, so that's pretty cool. Okay, this section is an easy one for me. I have studied the insurance industry a lot in the past, and I am fully aware of how big it is and how important it is for the world. Insurance was a brilliant invention because it allowed people to take risks, and I think it is the big reason the world can grow. I think it's the most underrated invention of the past 300 years. Now, machine learning in insurance is only going to make it better and cheaper for everyone, and that is exactly how Lemonade is positioning itself. It's a very smart idea, but there are going to be some teething issues. See, insurance companies take decades to become big and stable. Lemonade is only 5 years old, which is going to make it a bit tougher. Like those more mature insurance companies, they're going to have to weather a few storms. Okay, now we all obviously think insurance is super boring, and it needs to jump into the 21st century. So, from an industry point of view, Lemonade has a huge important industry to tackle, and making it less boring will win over a lot of people. And Lemonade currently exists in 28 states in America, Germany, France, and the Netherlands as well. Now, Lemonade is a little different from other insurance companies, and it's really an app on your phone. They try to make claims super fast, and it's supposed to be easy and simple. That is a good problem to have solved. Insurance normally is a bit of a pain to organize.
At Lemonade, when you pay us $1, you know in advance that we will keep a fixed fee, currently 25%. We use the remaining 75% to pay your claims and reinsurance, and if there's money left over at year's end, we give it back to nonprofits of your choosing. These two programs, our charitable giveback and our reinsurance, they act as ballasts, stabilizing our flat fee, and we believe that changes everything.
Claims are the most important part of our business. When you buy insurance, the product you're actually buying is the ability to file a claim. So we designed a digital process that allows us to handle and pay claims much faster. Our AI bot, Jim, can often determine if a claim is valid, and if it is, pay it in seconds. In about 96% of the cases, Jim will take first notice of loss. In fact, Jim handles, settles, and pays about a third of our claims instantly. This is all done with absolutely no human intervention.
So it all feels like rainbows and sunshine when we hear from the CEO. But let's wait and see when the first catastrophe happens and they are inundated with claims. That will be the test. And I really need to see how Lemonade performs when they have their backs against the wall. Okay, now I'm happy to be proven wrong here, but I think Lemonade is pretty much an insurance company with a fancy website. I guess the fast claims and the charity angle gives them some sort of point of difference, but look, insurance is big business, and to think that all the other insurance companies are not going to just modernize their websites and apps, it's a little naive to think they won't. So at the moment, I don't think they have a really strong competitive advantage, well, at least not a long-lasting one in my eyes. It will take years and years for us to see if Lemonade's competitive advantage is going to hold up. Plus, the company is not yet profitable, with Morgan Stanley forecasting net income profitability by 2026 and underwriting profitability by 2030. Yep, I said 2030. That's 9 years away if things go to plan. Wow. Look, they've done a great job marketing it to grow that customer base, so that counts for something. Revenue is growing fast as well, but I don't really want to wait 9 years for profitability. Now in this part, I normally look at things like return on equity and debt levels, but the company is pretty much a startup, so I can't really look at these things. They are spending a lot of money that they have collected from doing their IPO back in July 2020, and from the money they raised in seed rounds previously. So customer growth is the big story and why they were able to raise money in the first place. This is expected to continue for the foreseeable future as marketing and word of mouth spread the company around. Now the CEO and co-founder, Daniel Schreiber, has $4 million in stock, and Shai Wininga, not sure on the name there, the other co-founder has about $300 million in stock. They make up 6% of the ownership of the company. This is a little low for founder-based startups, but I do generally like founder-based companies. Look, but with only 5 years under their belt, it's just way too early to tell anything about their management team. Okay, now this part isn't going to be easy. I have little idea how to do this accurately. This is way outside my comfort zone, as I normally look at companies with solid, positive free cash flow. So valuing Lemonade is more speculation and gambling than investing, but I'll try my best to give it some sort of fair value. All right, so I can't use my price to growth to free cash flow method or my discounted cash flow method because, well, we don't have free cash flow. I can't use an earnings per share method like Phil Town would use because earnings per share is negative. So I'm going to try to use a price to sales guide for valuation. So if a company isn't earning a profit yet, we can look at the price to sales ratio to determine whether the stock is undervalued or overvalued. If the price to sales ratio is lower than comparable companies in the same industry that are profitable, then that is a sign of undervaluation. Now Lemonade's price to sales currently is 48. Compared to the industry average of just 1.19. And as you can see, this isn't going to work. Let me try a different approach. We saw earlier that customers are growing at like 136%, but from a low base. Analysts think it is possible to grow at 35% for the next 5 years. So in the year 2030, if they can grow at 35%, that will give them about 20 million customers. So let's also now assume they grow the amount their customer spends with them by, 15% per year. See, Lemonade plan to add things like pet insurance and life insurance and other insurance products to their existing customers, which will be great for their business. So I made this rough calculation over 10 years and the premiums reach about $18 billion in the year 2030. Some of the better profit margins in the industry are about 8%. So we get that $18 billion multiplied by 8% equals $1.4 billion would be earnings in the year 2030. So we give that a multiple of say 15, which is a bit above normal insurance companies. And we are at $21 billion future market cap in 10 years time. Now, considering the market cap is about $5.5 billion right now, that would mean if all these assumptions are somewhat close to correct at the current price, we might get 15% per annum over these 10 years. Okay, so the negatives are, at 35% growth, still only gives us about a 15% return on investment per annum. And that's not a big return considering the growth rate. Plus, a lot has to go right. 10 years is a long time to become just profitable. There's no margin of safety here. And what is the major long-term competitive advantage they have? I can't work out how they will really stand out in the long term. I guess the market is so big, even just a $20 billion company is a small insurance company and they will fit in. And like I've said multiple times, they're not going to be profitable until 2030. A lot of things can change in the industry in that time. And I have no idea about the management. I can't get much of a read on the management team yet. Maybe they are in it for the long term. Maybe they will just look to exit the business. I have no idea. And finally, there's no famous super investors invested in the company. Well, none of the super investors that I follow. But the positives do exist. Insurance is a very, very big market and there's huge room to grow. And disruption in the space is a good thing. I think they can take advantage of customers who are tired of the old ways. So do I think Lemonade is a good company to invest in? Look, if you want an insurance company that gets you about 15% per annum, well, there are already established, very well-managed insurance companies like Berkshire Hathaway, Markel, Fairfax, and Prudential. I've invested in all of these except Fairfax. Look, maybe I'll look at Lemonade in a decade's time. I don't think I'm missing out on much if I don't invest in this right now. Don't forget to subscribe so you don't miss my future videos. If I do look at Lemonade again, hit me up in the comments if you have an opinion. And obviously you will need to investigate a lot further if you want to invest yourself. But look, this hopefully has got you started. Oh, and don't forget to grab a few books below and I will see you in the next video.